Welcome to Market Meridian, your daily breakdown of the biggest moves in global finance. I'm Eric, your host today. A seismic shift is underway in the global financial landscape as top Wall Street firms, including Goldman Sachs, JP Morgan Chase, and Morgan Stanley, have officially revised their forecasts, pushing the expected timing of the Federal Reserve's first interest rate cut to late 2026. This dramatic policy reset marks a sharp departure from earlier projections, which had anticipated rate easing as early as the second quarter of 2026, and comes as a direct response to two key economic indicators: stronger than expected inflation data and a surprisingly resilient U.S. job market. For policymakers at the Fed, these signals have eliminated any urgency to pivot to an easing stance, cementing a higher-for-longer interest rate environment that is reshaping investment strategies, market dynamics, and the broader global economic outlook. To understand the magnitude of this policy reset, it's critical to unpack the economic data that has driven Wall Street's revised forecasts. As of March 13, 2026, the latest U.S. economic indicators paint a picture of an economy that is holding steady, even as inflation remains stubbornly above the Fed's 2% target. East Asia Time March 11, the U.S. Bureau of Labor Statistics released February inflation data, showing that the unadjusted Consumer Price Index, CPI, rose 2.4% year-on-year, while core CPI, excluding volatile food and energy prices, climbed 2.5% year-on-year, both matching market expectations and holding steady from the previous month. While this marks a slight cooling from the 2025 year-end peak, it is still above the Fed's long-term target, and the recent surge in global oil prices, breaching the $100 per barrel mark, has raised fears of a potential inflation rebound. Further complicating the Fed's policy calculus, complementing the inflation data, is a U.S. job market that has proven far more resilient than anticipated, despite fears of a slowdown. The January 2026 non-farm payroll report, released in early February, showed a net gain of 130,000 jobs, far exceeding the market expectation of 50,000 to 75,000, and the unemployment rate edged down 0.1 percentage points to 4.3%. While the February report, released earlier this month, showed a modest slowdown, with non-farm payrolls falling by 9.2%, a reversal from market expectations of a small gain, analysts note that the labor market's underlying strength remains intact, with robust hiring in healthcare, social assistance, and construction sectors offsetting weakness in federal government and financial services jobs. Average hourly earnings also rose 3.7% year-on-year in January, signaling that wage pressures, a key driver of core inflation, are still present, giving the Fed little room to ease policy prematurely. The Fed's current policy stance, which has maintained the federal funds rate target range at 3.5% to 3.75% since January 2026, reflects this data dependent approach. The Federal Open Market Committee, FOMC, meeting minutes from January 28 showed a unanimous vote to hold rates steady, with 10 members in favor and just 2 dissenting, who advocated for a 25 basis point cut. The minutes emphasized that policymakers are closely monitoring inflation and labor market trends, with a clear message: rate cuts will only come when there is convincing evidence that inflation is on a sustained path toward the 2% target. Adding to the policy uncertainty is the upcoming leadership transition at the Fed. President Trump has nominated former Fed to replace Jerome Powell as Fed chair, a move that, if approved by the Senate, will see a new leader take office by late May 2026. Analysts at Citi note that under Powell's remaining tenure, no rate cuts are likely, with potential easing of 1 to 2 25 basis point cuts possible under Warsh's leadership in the second half of the year. This Fed policy reset has sent ripples across global financial markets, reshaping investment strategies across equities, bonds, and precious metals, 3 asset classes that are particularly sensitive to interest rate changes. For equities, the shift to a higher-for-longer rate environment has created a delicate balancing act. Investors are weighing the benefits of a resilient U.S. economy, which supports corporate earnings, against the headwinds of extended tight monetary policy, which increases borrowing costs and compresses valuations. The S&P 500 has traded in a narrow range over the past month, down approximately 1.2% from its February peak, as investors rotate out of rate-sensitive sectors and into quality stocks with strong balance sheets and stable cash flows. Technology stocks, which have long benefited from low interest rates, have been particularly hard hit, with the Nasdaq Composite down 2.3% since the start of March, as higher rates reduce the present value of future earnings. Conversely, value stocks, particularly those in defensive sectors like healthcare, consumer staples, and utilities, have outperformed, as investors seek stability in an uncertain rate environment. For example, Johnson & Johnson J&J has gained 3.1% over the past month, while Procter & Gamble, PG, is up 2.7%, as these companies' consistent dividends and low debt levels make them less vulnerable to higher borrowing costs. The impact is not limited to U.S. equities. Global markets, particularly emerging markets, are feeling the pressure of higher U.S. rates, which attract capital flows away from riskier assets. As noted by the Global Times, higher for longer rates in the US and Europe have created persistent capital outflow pressure for Chinese equities, though recent fiscal stimulus and central Huajian's increased holdings have helped stabilize the market somewhat. Bond markets have experienced even more pronounced volatility in response to the Fed policy reset, as investors adjust their portfolios to reflect the revised rate cut timeline. The yield on the 10-year U.S. Treasury note, a benchmark for global borrowing costs, has climbed to 4.2%, up from 3.8% at the start of February, as investors sell existing bonds, which pay lower yields, in favor of new bonds with higher coupon rates. Short-term yields have risen even more sharply, with the 2-year Treasury yield hitting 4.6%, creating a flattened yield curve, a dynamic that typically signals investor uncertainty about future economic growth. Bond investors are now shifting toward shorter duration bonds, which are less sensitive to interest rate changes, and away from long-term bonds, which face greater risk of losses if rates remain elevated. Municipal bonds and corporate bonds have also come under pressure, with spreads, the difference between their yields and Treasury yields, widening as investors demand higher compensation for risk. Precious metals, and gold in particular, find themselves caught in a tug-of-war between conflicting market forces amid the Fed policy reset. Gold has long been viewed as a safe haven asset, and ongoing geopolitical tensions, including the Middle East conflict and economic uncertainty, have supported demand, pushing London gold prices to a recent high of $5,133.68 per ounce. However, gold is also highly sensitive to real yields. The yield on Treasury bonds adjusted for inflation, and rising real yields have put downward pressure on the metal, as they increase the opportunity cost of holding non-yielding assets like gold. As of March 13, 2026, London gold was trading at $5,078.70 per ounce, down 1.07% from the previous day, reflecting this balance of forces. Silver has faced similar pressure, with London silver down 0.9% to $83.838 per ounce, as the Fed's tight policy stance outweighs safe haven demand in the short term. For ordinary investors, the Fed's policy reset is not just a market story, it is a call to rethink their investment strategies, with a renewed focus on quality, income, and portfolio flexibility. Financial advisors across Wall Street are urging clients to move away from speculative, high-growth assets that thrive in low-rate environments and toward more defensive positions. This includes increasing allocations to high-quality corporate bonds, dividend-paying stocks, and alternative assets like real estate investment trusts, REITs, which can provide steady income while offering some protection against inflation. Diversification has also become a key priority, as the volatility across asset classes underscores the risk of overexposure to any single sector or market. Looking ahead to the next 24 hours, the trajectory of financial markets will be largely shaped by three key factors: fresh economic data, Fed communications, and market sentiment, all of which will provide critical clues about the Fed's policy path and Wall Street's rate cut expectations. Here's a detailed forecast of what to expect in the coming days. First, the release of U.S. retail sales data for February will be a key focal point. Market expectations call for a 0.3% month-on-month increase in retail sales, reflecting steady consumer spending amid resilient employment. A stronger-than-expected reading, above 0.5%, would reinforce the Fed's higher-for-longer stance, as it signals ongoing economic strength, and could push Treasury yields higher, weighing on equities and gold. Conversely, a weaker-than-expected reading, below 0.1%, could reignite hopes of an earlier rate cut, even if marginal, leading to a short-term rally in stocks and gold, and a pullback in yields. Investors will also closely watch the core retail sales data, excluding auto and gasoline sales, for a clearer picture of underlying consumer demand, as gasoline prices have been inflated by the recent oil price surge. Second, comments from Fed officials will be closely monitored for any hint about the policy timeline. Fed Governor Christopher Waller, one of the two dissenters in the January FOMC meeting who advocated for a rate cut, is scheduled to deliver a speech on monetary policy in New York at 10 a.m. Eastern Time. Waller's comments will be particularly closely watched, as his views could signal a potential shift in the Fed's thinking. If he maintains his dovish stance, suggesting that a rate cut could still be warranted in the near term, markets could rally. If he adopts a more hawkish tone, emphasizing the need to hold rates steady to combat inflation, yields could rise and equities could come under pressure. Additionally, investors will pause any new comments from Fed Chair Jerome Powell, who is scheduled to participate in a panel discussion later in the day, for clues about the Fed's assessment of inflation and the labor market. Third, market sentiment and technical factors will play a role in short-term movements. The recent volatility in equities and bonds has led to high levels of speculative activity, with hedge funds adjusting their positions to reflect the revised rate cut expectations. Technical resistance levels for the S&P 500, around 5,200 points, and the 10-year Treasury yield, around 4.3%, will be closely watched. Breaking these levels could trigger further momentum, while a failure to break them may lead to profit-taking. Gold, meanwhile, is testing support levels around $5,050 per ounce. A break below this level could lead to further declines, while a rebound could signal renewed safe haven demand. In terms of sector-specific impacts over the next 24 hours, defensive sectors like healthcare and consumer staples are likely to remain resilient, as investors seek stability amid rate uncertainty. Financial stocks, particularly banks, could see gains if Treasury yields rise, as higher rates boost net interest margins. Conversely, rate-sensitive sectors like technology and real estate may face pressure if yields climb further. For currencies, the US dollar could strengthen if Fed comments turn hawkish, as higher rates attract global capital, while currencies of emerging markets may come under pressure. Gold prices will remain volatile, with a balance between safe haven demand and real yield pressure dictating short-term movements. The longer-term outlook for Fed policy and financial markets remains highly uncertain, with the timing of rate cuts dependent on three key variables: inflation trajectory, labor market strength, and geopolitical developments. If inflation continues to cool toward the Fed's 2% target and the labor market softens moderately, Wall Street may revise its rate cut expectations back to mid-2026. However, if inflation rebounds, driven by sustained high oil prices, or the labor market remains overly resilient, rate cuts could be pushed to 2027. As noted by HC Stocks, even if oil prices remain elevated, the Fed may still proceed with rate cuts if long-term inflation expectations remain stable, creating a delicate balance between controlling inflation and supporting economic growth. For now, the Fed's policy reset has upended the market's conventional wisdom, forcing investors, businesses, and policymakers to adapt to a higher-for-longer rate environment. Businesses are already adjusting to higher borrowing costs, with small and medium-sized enterprises, SMEs, reporting tighter credit conditions and reduced investment plans. Consumers, meanwhile, are feeling the pinch of higher interest rates on mortgages, auto loans, and credit card debt, which could weigh on consumer spending in the coming months. At Market Meridian, we will continue to monitor this developing policy landscape closely, bringing you every critical update as it happens. Whether it's breaking news on inflation and employment data, comments from Fed officials, or shifts in market sentiment, we are committed to keeping you ahead of the markets and providing the expert insights you need to make informed investment decisions. Stay with us all day long as we break down every angle of this Fed policy reset and its impact on global finance.